Knowing when and how to borrow and how to get the right deal for you is key to strengthening your overall financial situation and in helping you reach your personal financial goals. Whether you want to borrow money to cover the cost of repairing a broken down boiler, for a big purchase like a house, or are looking to get a new credit card, there are many options out there. Here, we'll cover 3 key areas to help you borrow cleverly. 1. Types of credit. There are 2 basic types of credit: secured and unsecured. Secured credit is tied to or secured by something you own. Examples of secured credit include mortgages, car finance, and pawnbroking, all of which are secured by an asset, your house, car, or a particular item of similar or greater value to the amount you want to borrow. If you fall behind on your payments or don't pay back the credit, then the lender could repossess this asset. Because of this, the risk for the lender, and therefore the interest rate for the customer, is usually lower on secured loans than unsecured. Unsecured credit. Unsecured credit is credit that is not tied to an asset. The lender has no direct claim to an asset to repossess if you default on your repayment, so the loan is made on good faith based on your application and financial history. Because of this, the risk for the lender and interest rates for the customer are usually higher than many forms of secured credit. Some examples of unsecured loans include credit cards, personal installment loans, payday loans and other short-term loans, and unsecured lines of credit. Let's look at some of these unsecured options. Firstly, keep in mind that payday loans and other short-term loans are not appropriate for all situations, and that short-term credit tends to be high cost, so it should only be used for unexpected expenses. Used appropriately, they can be useful when other options, such as incurring overdraft fees or late charges, are more expensive. Always remember to compare costs and terms. There can be big differences between providers. And try to pay your loan back as soon as you can if it could save you money on interest and fees. Now let's have a look at credit cards. A credit card is basically a loan from a bank or credit card company, or in some cases, a retailer. Credit cards offered by retailers are not to be confused with store cards, which work in a similar way to credit cards but can only be used in a particular store or group of stores. A credit card allows you to make purchases and get cash advances, then pay back some or all of that money, plus interest and fees, on a monthly basis. This allows you to purchase items now and pay for them over time. Some credit cards offer benefits, like cashback on purchases, reward points you can redeem for air travel, hotel stays, purchases, and other incentives. Others may offer introductory interest rates, often 0%. Just remember, perks should factor into your decision only after you find the best card for your circumstances, and especially with lower introductory rates, you'll need to make sure it's still affordable for you even after the offer ends and the interest goes up. 2. Key financial terms. As you're weighing up your borrowing options, there are some commonly used financial terms you'll need to know. Terms like credit limit. Your credit limit is the maximum amount you can borrow. With most credit cards, if you spend over your credit limit, you may incur a penalty and fee. Minimum payment is the very least you can pay towards your outstanding balance and not be penalised. Minimum payment amounts vary based on the size of your outstanding balance and the terms of your loan or credit card agreement. To pay your credit off sooner, it's important to pay more than your minimum payment if you can, to minimise your interest and fees. Right to withdraw. All credit agreements allow 14 days from the date your card arrives or your loan agreement is executed, where you are able to change your mind about having the credit. Even if you cancel, you usually have to repay accrued interest from the time you borrowed any credit under the agreement. APR is the annual percentage rate. APR is the interest and other fees you'll pay on the amount you borrow, or the balance you carry, compounded and expressed as an annual rate of charge. The calculation is complex, but it's required by law to be calculated consistently so you can compare different loan options. Remember that with short-term credit and payday loans, the term of the loan will usually be much less than a year, often only a few weeks or months, so APR doesn't always give an accurate representation of the total cost of borrowing. Some lenders and credit cards may also have multiple rates, including different rates for purchases, cash advances, and credit card balance transfers. Make sure you read your credit agreement to find out how different rates can affect you, and so you are aware of any penalties and charges. Most lenders have these, but they can vary significantly between lenders. Fees are additional charges or penalties applied by your lender for various reasons. Some common examples include late payment fees, over-limit fees, overdraft fees, and ATM withdrawal fees. Be sure to carefully check your loan or credit terms and conditions to make sure you understand how fees may impact you. 3. Clever borrowing tips. Tip 1. Don't overextend yourself. Only agree to the credit or loan amount you feel comfortable borrowing based on your ability to pay it back over the time period allowed, and making sure you can handle the rate and terms. Whether it's a personal loan, credit card, mortgage, or car loan, too many people borrow more than they can afford to pay back and have difficulty repaying their obligations. This can result in higher borrowing costs, an impact on your credit score, and in some cases, reduce your ability to get credit in the future. Tip 2. Pay your bills on time. Even if you can only afford to make the minimum payment, pay your bills on time to avoid penalties. Signing up to pay your bills by direct debit or standing order can be a convenient way to pay. The money is taken automatically from your bank account, and you don't have to worry about the payment being late. Make sure you have enough money in your account to cover the bill though, as direct debits that are returned unpaid can result in penalty fees from your bank or service provider. Try to schedule your payment dates for a few days after your payday to ensure you have funds available. Many lenders and service providers will change your payment date to one that suits you if you ask them. Just give them a call. Tip 3. Pay more than the minimum. Whenever possible, pay the most you can afford towards your monthly loan or credit card repayments. You'll pay down balances faster and could pay less in interest charges too. Tip 4. Read your bill statements. If you see changes in rates, errors, or suspect that you have been a victim of fraud, speak with the credit card or loan company at once. Immediately dispute any charges you don't recognise and ask the company to investigate. Tip 5. Save your receipts, so you can check purchases against charges on your monthly statements. If anything looks unfamiliar or suspicious, report it to your bank or card issuer immediately. Be sure to shred old statements and card receipts that you throw away. Personal data theft is behind 65% of fraud cases, so do your best to keep your personal information private. Protect your details, in case your cards or identity is stolen. Notify your card issuer immediately if you lose your cards, and you should never write down passwords or PIN numbers. To be a clever borrower, ask questions and make informed choices. Lending is a complicated business. The real cost of borrowed money can escalate very quickly if you don't meet the terms and conditions you agreed to or didn't understand in the first place. The more you know about how and when to borrow the right way, the better your personal financial situation will become. Thanks for watching, and don't forget to check out the resources below for further information. Good luck!